Hey guys, your agent Tyler Wayrung here with Keller Williams, and today we're going to talk about the outlook in 2021 for the housing market. There's a lot of talk about whether or not the market's finally going to crash. Will it continue to boom? Or what kind of factors it might play into that. So we're going to break all that down for you, kind of relate some things back to the 2008 crash, and then give you our prediction on what we think we might see for the rest of the year. So with that, let's dig in. All right, guys, so it kind of goes without saying, but no one really knows what the future might hold. We're going to make some predictions here today based on things that really drive the housing market. We're going to talk to you about the big factors there. We'll talk about some things that impacted the 2008 crash and how we're seeing those play out today. And then we'll also talk about the current environment and our predictions for the rest of the year. But don't hold us to anything in particular. Something could happen tomorrow that changes all of this. But based on the information we know today, here are our thoughts. All right, so in general, there are really three main things that impact the housing market. Again, some people's whole day job is to study this and can break it down into probably 1,000 different variables. But for simplicity's sake, we're going to kind of use three generic categories. The first being supply and demand, the second being affordability, and the third being the general economy. So we'll break all those down in a little bit simpler terms, but the age-old economic principle of supply and demand definitely applies here in the housing market. When the demand is super high, that tends to lead to a lower supply because all those people are buying, and vice versa is also true when there's an extreme amount of supply. The demand is not as high because those people are able to find what they need and there's not an over surplus of anything sitting on the market. And then in terms of affordability, this really comes down to the availability of funds for a down payment and the monthly expense that the typical home buyer can afford. So those are the two primary principles that go into affordability. And the third factor around the general economy, these are things like, are people holding good jobs? Is the unemployment rate high? What's the emotional state of the economy? After all, buying a home is an emotional decision-making process for the most part. Now, there is some logic involved, but people primarily make decisions based on emotion, and that's the same with the stock market. So there are some interrelations between the general economy and the housing market as well. All right, so let's look back to 2008. What are some of the things that caused that crash? We hear a lot of people say, we're going to wait for the next 2008, or if I would have bought in 2008, my property would have doubled by now. I'm going to wait until the next crash and buy one 50% off. Well, there were some very particular things about the 2008 crash that we don't foresee happening again, so that might not be the best strategy, whether you're looking for an investment property or a home to buy for yourself. So let's look at some of the things that went on there. All right, so there were a ton of variables that went into the 2008 crash, but I think most people agree there were 3 or 4 big things that happened that really led to the downfall, which then turned into a snowball that went the wrong direction. But so some of those things, a brief timeline is there. Back in 04, 05, 06, there was a surplus of houses being built by a lot of the big national builders, which then led into the kind of lowering of mortgage standards or giving out more subprime mortgages to put people that may not have passed traditional underwriting into some of these surplus of homes. That was a solution to maybe solve this. But what happened was there was a huge influx of subprime mortgage lending, which is basically lending on things that are a little bit more risky, more adjustable rate mortgages. There were even 2-year adjustable rates, just things that shouldn't typically be done. They were giving mortgages out to people with very low credit scores, people with little or no income at all, and really no financial viability to sustain or be able to perform on the mortgage. So, there's a joke said about in 2008, if you could fog a mirror, you could get approved for a mortgage. So essentially, if you were alive, you could get a mortgage back then. And so this was great for a couple years. It solved the problem of the housing surplus, but it didn't take long for these people who shouldn't have been in these homes to start defaulting on mortgages. So what traditionally happens with a mortgage once you get it with a lot of the bigger banks? Now, this isn't the case for all banks, but most banks will underwrite a mortgage with you. Then they'll sell that mortgage off to a secondary market. These mortgages are put in huge pools of maybe 10,000 mortgage notes and are sold to these giant hedge funds in the form of a mortgage-backed security. So these hedge funds will buy these, and when you make these monthly payments, they're the ones making the interest on these notes. But what happened when people started defaulting on their notes, these huge hedge funds that had a lot of these mortgage-backed securities started to not receive their payments, which then they started to default. And the Lehman Brothers were an example, and I believe they were the biggest U.S. bankruptcy in history. And then they were quickly followed by Fannie and Freddie Mac, which both had to be bailed out by the government. That was kind of what really started the downfall of the economy in 2008. So the whole point of all that, what I want you to get out of this, is really the mortgage or the housing market is what was a key factor in the housing market crash of 2008 or the economy crash of 2008. So while we saw the price of houses fall drastically during that recession, it wasn't the same proportionally to other recessions in history because the housing market was a key factor in why it went down in the first place. So the point is, if we are to have another recession, but it's kicked off by something else, or maybe the stock market falls off a cliff, that may or may not impact the housing market as big as the housing market being a key factor to a recession. So just don't bank on house prices falling like they did back in 2008. We may have another recession, but I don't think there's any recession in history that was exactly the same. So just don't use those predictions when planning for your next big move in the real estate industry. All right, so let's talk about the current environment of the real estate market today. It is first quarter of 2021, and let's start off looking at mortgage standards. So obviously before we highlighted, these was a major factor in the 2008 crash, and we're seeing these still to be held pretty firm. A lot of banks and the mortgage industry in general learned a lot from that. We don't see that being a risk factor here in 2021, but we'll see what the future holds there. All right, so in the beginning we talked supply and demand, so let's talk about the inventory in 2021. So I think most people will tell you the housing market is crazy right now. There's extremely low inventory in most places, 1 to 2 months. The National Association of Realtors kind of calls a healthy balance of supply and demand when there's approximately 6 months of inventory. And we're down in 2 and even less in some markets. So inventory is extremely low right now, which that is the supply. So again, like we said before, when supply is low, demand is high. When there's a high demand, that is kind of propensity for a continuous strong housing market. So everything we're seeing today kind of leads us to believe that the housing market will continue to boom in 2021 if all else remains the same in terms of inventory. So let's take a look at affordability. When it comes to affordability, kind of the two biggest barriers to entry in terms of buying a home is funds for a down payment and then the income to support a mortgage payment or the expense associated with that mortgage. So let's look at the down payment. Funds for the down payment are often difficult to come by for the first-time home buyer, but there are a lot of programs to help out with that in terms of lower down payment percentage-wise. And often cases it can be as low as 3.5%. So in 2021, we're just coming off our second stimulus check, and who knows how many there will be in the future. But the responsible buyer is out there working on their down payment. They've gotten 2 stimulus checks to help them out with that. So we see that being a plus in terms of down payment affordability. And President Biden currently has a bill out there for $15,000 tax credit. So that really aids first-time home buyers in that first barrier to entry in terms of coming up with the down payment. Now that isn't passed yet, but it is proposed. So if that goes through, we would predict an influx in first-time home buyers out there in the market, kind of increasing that demand on an already low supply. So we see that being a factor in 2021. Like we touched on before, the other piece of affordability is the monthly expense associated with the mortgage amount. Now, this is a function of the down payment and the purchase price of the home. All that together kind of gives you a monthly amount, and that's what you're pre-approved on. So like we touched on, if these down payment funds become available, we have additional stimulus money, this could be put towards a house and would lower what the down payment might have been in the past. Interest rates are also a key factor in that function, and currently today we're at historic low interest rates. And interest rates are tied to the treasury bonds or the T-bond market. And all predictions out there say that T-bonds are going to slightly rise in 2021, but most are predicting they'll be relatively flat. Most of the forecasts for the rise are less than 1%, and the interest rate market is just a point or two higher typically than the T-bond market. So all predictions around interest rates say we might see a slight rise throughout 2021, but nothing crazy or significant. And if we look back 10 years, even a rise of a point or two would still put us at historic lows. So how that relates back to affordability is interest rates being a function of that down payment and purchase price. Those are kind of the variables that get you to that monthly expense. As long as interest rates remain low, we see the housing market continuing to rise as buyers are able to pay more for that same house and keep the same mortgage payment as they would have in the past with higher interest rates. All right, so lastly, let's talk economy. The current economy is booming for all intents and purposes. The Dow Jones is always flirting with new all-time highs every week. That means people's 401ks are booming, hitting all new all-time highs. This gets people in kind of these higher emotional state. They're more confident to take risks with homes when they know that their other assets are climbing as well. Good paying jobs, unemployment's relatively low considering we're just coming off the COVID-19 pandemic, and all signs are really actually positive right now for the overall economy. And also with increasing home prices, a lot of people are seeing what their home is worth and are deciding to sell. They're looking at how much they can make if they sell right now. And if you have a family and you're living in a home that you're going to sell, you're going to need to find a new place to live. So then with this extra funds, your actually price that you can afford goes up. And it's kind of this domino effect of, those people are selling, they need somewhere to move, and they have a big influx of cash. They can now afford something higher. So those are all factors that lend to believe that the housing market will continue to boom throughout the rest of 2021. The big question mark comes into play when it comes to forbearances. So forbearance is something implemented by the mortgage industry, and what it basically means is they're allowing you to either pay a lower amount or not pay at all and kind of move that payment to the very back of your loan. They just implemented this to not put themselves in that same position as they did in 2008, where they potentially were stuck with these houses where people couldn't make payments on. This is a temporary relief that they are trying to help people out with to be able to keep their home and kind of make up the payments instead of giving the home back to the bank. The bank is not in the business of owning houses. They're in the business of creating notes and servicing those. So we still don't know how all that's going to shake out. This is something we've never seen before. It'll take probably a couple quarters before we start to see the impacts of that. But at this point, it's too early to tell. And even if we looked at the worst case, we still see so many positives leading toward a booming housing market that we don't think forbearances will play a significant role. But with all that being said, none of this should really be a key factor in your decision-making process. You shouldn't pay more for a home than you're comfortable with just because you think appreciation will continue to rise. Don't put yourself in that position. You still need to do an adequate financial audit to make sure you're ready to buy. You should only buy up to an amount that you're comfortable for, and you should definitely ask some good questions before you go into the home buying process. We'll link to a video above of good questions that we think you should definitely be comfortable with before moving forward. But we just made this video for a lot of the folks who are sitting on the sidelines waiting for the housing market to fall off a cliff, and to let you know we don't think it's coming anytime soon. We'll continue to keep our pulse on the market, but at this point we see all signs are up. And if you are ready to look for a home or you need help finding one, give us a call. We're always happy to chat with you about your house, your situation, and how we might be able to help. If this video helped at all or you think somebody else needs to see it, they have different thoughts on what's coming in 2021, please share. A like on the video is always appreciated. If you have other thoughts, drop them in the comments below. Those are always appreciated as well. And with that, I'm Tyler Wayrung with Keller Williams. We'll catch you next time.